Welcome to Chit Chat Stocks. This is our weekly Power Hour episode. I am one of your hosts, Ryan Henderson, and I am joined, as always, by Brett Schaefer. We've got a lot of news on the docket this week. They're on the show. For anyone that's new to Chit Chat Stocks, on the Power Hour episodes, we riff on all things financial markets, whatever's in the news for the week. We'll usually come with some predetermined segments as well. I've got my small cap of the week, which it's probably, I'll just say it now, the most aggressive insider buying I've ever seen. So hopefully that keeps you captured until we get to it. But Brett, you've got some segments as well. We've got a short report, huh?
Yeah, we got some spicy stuff this week. Earnings are kind of mild. We're recording this before NVIDIA's big earnings report, which hopefully this hour-long podcast will be a reprieve from any discussion on NVIDIA, which is getting quite tiring. But yes, I have two things. One, a short report on Super Microcomputer, which might be the most damning and concrete short report I've ever seen. The red flags are numerous. And then also PDD Holdings, owner of Pinduoduo and Temu, had an interesting press release that confused a lot of investors, also scared them. Stock went down 30%. Thought it'd be a fun one to discuss, especially with our, I don't know if they're hot takes, but negative takes on Chinese stocks.
All right. Before we get to that, though, we want to talk about our friends. If you trade options, you've got to ask yourself, why wouldn't you choose an options trading platform that puts investors first? At public.com, there are no commissions or per contract fees. And more importantly, it's the only platform where you can earn a rebate on every single contract traded. That means you can save on your options trading costs and keep more of your capital in play. Whenever you trade options on Public, your savings are automatically applied. So don't change your strategy, change your platform, and see the difference in your bottom line. That's no commissions, no per contract fees, and it's the only options trading platform where you can earn a rebate on every contract traded. Public.com. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. Where do we want to kick things off? Because a lot of news this week. Alimentation Couche-Tard looks like they're gobbling up the convenience store industry, buying out 7-Eleven potentially. Carl Icahn, who I always kind of I don't want to pat myself on the back yet. I had a little bit of a bad feeling about this guy, and some of it's been validated by a recent SEC charge. So we can talk about that as well. But I feel like it might be more interesting to kick things off with the short report.
Sure. Yeah. Hindenburg Research, for people that don't know, the ones that I think became famous after exposing the Nikola fraud, which not necessarily the hardest short to find or the hardest fraud to identify, but one that was one of the best stories out there, especially with that founder who turned out to be a total charlatan. But for anyone that doesn't know, Super Microcomputer, it's been an AI winner. Revenue has actually absolutely exploded. If you check out any charts on FinChat, you can see that it went from basically a stagnating company to just exploding in revenue. And the reason is that they build and basically assemble servers for data centers. So a company like AWS, a company like Meta, anyone that's building any big data center is going to want to make it as efficient as possible. And Super Microcomputer, along with Dell, says they're an expert in this and will basically take chips from NVIDIA, other sources, and all the connecting equipment, all the complications, which I know nothing about, for building efficient computing servers. And they hopefully can provide value there. And it looks like, I think just reading the bullet points from the Hindenburg report, there are a lot of red flags. I should note, we just released a podcast on Peter Lynch this week, and this would have been one he would definitely avoid because it's a company with a name that is essentially the theme of the hot sector of the day. And it's also one of the stocks in the hot sector of the day, which is something he always avoided. And I think if you look at the stock price now, probably to his benefit. So what was in the report? Let me just list off some things and see if you would think this is an investable company or goes on your do not fly list. First, SMCI, which is their ticker, had an accounting scandal in 2018, fired the executives around the accounting scandal, and then rehired them 3 months later. Now, the accounting scandal was around channel stuffing, which They are apparently doing now, according to Hindenburg, after their investigation. There are partial shipments and defective shipments around quarter end, which is channel stuffing to boost revenue. Now, what I thought was the most interesting are circular accounting with the related party companies that solely do business with SMCI. So these are people that are either extended family or family members with super microcomputer executives. They have these companies that do 99% business with super microcomputer. So SMCI sells them products. Then eventually the products get sold back to SMCI. What does that do? Boost revenue. People like revenue growth. People don't really like looking under the hood when there's a bull market and the stock's up 1,000%. They have in the past, not sure if they're doing this today, exported banned components to Iran. They violated exports to Russia after the war in Ukraine started. And they have deals with a Chinese company that has been reported for human rights violations. So the trifecta of banned countries. Maybe if they sell to North Korea, they can get the Mount Rushmore of companies that U.S. or countries that U.S. companies aren't allowed to do business with. And then today, this is why the stock is down. I believe it's down 20% today on top of down already. Wow, it's totally collapsing. It's down 27% as of this recording. I should say still up 40% year to date, but off of its high. It was already off 50% of its high before today. Now it's down another 30%. And that is because they just delayed their 10K filing because they got to work on some accounting stuff. So, Ryan, are you investing or are you are you out of this one? I think the answer is pretty obvious for this type of stock.
Yeah, obviously not investing. I was concerned about the fundamentals, I guess, when we looked at this. I want to say 6 months ago, roughly, where it wasn't necessarily like the revenue was growing really quickly and it was getting a premium valuation, and we both kind of came to the conclusion that there's no way to know whether this is sustainable or not, or whether competition will come in and compete away any sort of revenue it's generating from being an AI beneficiary. So there was concerns there. This solidifies every other concern I have. So it's not like this is just a 66% drawdown on a really high quality business. It's on quite a fragile one, and it sounds like maybe a fraudulent one.
Yeah, I don't want to make allegations because this is a public thing and people can get in trouble for that, but the red flags are numerous. I think there might be 10 just in the bullet points at the top of the Hindenburg report, and any one of these things would keep me out of a company, especially one that's in the early stage, that's in a hot sector where the thing about a hot sector like AI or the dot-com bubble in its day or cannabis in 2018, that's where the fraud ends up because the fraudsters go to that space. Talk about EVs, talk about what was it? Crypto. The charlatans go to that space because they think they can make easy money. Now, not all the companies are frauds, but more often than not, some of them will be. I think it's pretty clear, and it seems like Hindenburg is shooting fish in a barrel with this one.
Yeah, I'm trying to look through the insider trades to see, if companies were just dumping stock.
For SMCI.
Yeah, or executives were just dumping stock. I'm not really seeing it. I mean, every single executive seems to be exercising their options and selling.
Beautiful.
So must be a nice time to be them. Yeah, they're just getting hundreds of thousands of dollars of stock options and selling.
We got some questions from the audience. I think
there's basically been a Form 4 every single day for the last 3-4 months. So
yeah, well, I think that's a good way to close out the first segment there. Classic short report. John Gallegos in the comment says, I have been looking at reducing my SGOV position. I think that's the short-term treasury ETF due to decreases in interest rates and moving toward high dividend great companies. He says he has EQNR 12%, BTI, British American Tobacco 11%, Ultra 8.5%, and then a few others that have dividends above at 7% or higher. Yeah, I think that makes sense. I would actually also look at the new product from our sponsor, Public. It seems like a very innovative product where they have this essentially fixed income fund that pays out a very high interest rate above a high yield savings account if you want to lock in interest rates, or maybe not lock in, look at the full product disclosure. I haven't looked at the whole thing yet, but I'll check that out. But yeah, some of those dividend stocks definitely make sense. We have a comment or question here from Tyler. I think it's inverting kind of the hot sector question. What are the sectors that you think are not in favor right now? What sectors would Lynch be looking at, and what sectors would he be avoiding? Well, let's maybe not. I mean, he'd be avoiding AI. I think we can focus on what ones he'd be looking at. One is definitely alcohol, spirits, and beer. Not loved at all right
Yeah.
now.
Yeah, definitely neglected, and everyone just seems to be discarding a lot of the beer companies because of the current trend in drinking. I don't know if I
Well,
have any sectors in mind.
at the start of this year, I would have said tobacco and nicotine, but the stocks over the last few months have just absolutely done really well. So maybe not so much now. Tyler has a follow up here that says, why do you think people aren't drinking as much? I think there's more of a stigma against it, and possibly Ozempic and GLP-1s, and then definitely the growth of cannabis is taking share.
Yeah, there seems to be more and more alternative ways to get a buzz or feel.
Here's another one that's neglected that we're afraid to invest in: online dating.
Yeah, big time. And, I was going to say gaming, but maybe not. Oh gosh, it's just lost. Oil and gas seems to be very neglected, and I'm probably going to continue to neglect it because I don't know how to analyze those companies. But it's one of those where actually anything cyclical right now or deemed to be cyclical seems to just be pushed to the wayside, especially a lot of stuff that's related to the housing market, like Home Depot, Lowe's. They haven't really gotten the, I guess, discount that I was hoping for, but a lot of the home builders seem to still trade at single digit earnings multiples. Not quite what they once were, but certainly people seem to have soured on those. And going back to John's question around reducing short term treasury exposure and maybe going for some of the higher dividend yield players, typically, if you find a company that has a dividend yield double or 1.5 times the short-term treasury rate, there are some concerns typically around them being able to grow that over time, or it's typically maybe in a low to no growth industry or cyclical. Like the first one he mentions here is EQNR. I believe that's a Norwegian oil and gas play. I would say take a basket approach unless you have very, very good understanding of the business and you think it's going the right direction, that kind of thing. I would take a basket approach to the high dividend yields as opposed to just picking any one.
Yeah, makes sense. Yeah, I think I agree, but I don't know anything about
I
oil
know
and
you love
gas, so it's
Ultra,
tough.
but
Yeah. All right. Next topic. You got a few on your list here. What do you want to hit first?
we could go. I do want to talk about my small cap of the week, but we can save that for a second. Alimentation Couche-Tard. I think it might be Alimentacion. I don't know. Alimentation. I can't pronounce it. Couche-Tard is offering to buy 7&I Holdings, which is a Japanese company that runs 7-Eleven. And this is $31 billion in value is the offering. 7&I Holdings, I believe, stock jumped 23% after the offer. These are, I believe, the two largest convenience store operators in the U.S. Combined, they would have roughly 13% market share of the U.S. convenience store segment. The second closest player would be Casey's, which I think has less than 2% market share. So they are, I mean, it's still only 13% market share. It's convenience stores, so pretty competitive industry. But I guess thoughts here. Do you think this could go through? And then second question, Would you have any interest in investing in the combined company?
No idea if it goes through. Seems like it probably should, but again, hard to tell. I have no interest in buying this, but I do have interest in the convenience store space. It seems interesting. It seems like maybe one of those underfollowed, unloved sectors at the moment. Definitely not a sexy sector, but I would be much more interested in a Casey's or a Murphy USA that is smaller. And I just don't like this kind of conglomerate style. I feel like maybe whatever you call this company that's acquiring them, I think they're Canadian, right? They are, yeah, they're just maybe they have a good track record, but I don't want to invest in a large company in this space because there is limited upside. There's just limited total addressable market. I'd maybe be interested in some of the dollar stores, Dollar General, Dollar Tree, but yeah, it-
I like the convenience store space a little more. Total revenues for 7-Eleven's gone kind of nowhere in terms of the top line, but ACT, let's call it, has done a really good job growing their business. I wonder if there's really a whole lot of economies of scale here. Like, is there any benefit of these two companies being together? Synergies, you think?
Yeah, they'll talk about classic stuff like negotiations with suppliers or back office things, but I don't think at the end of the day it's going to matter too much. Are these solid businesses? Yeah. Are they hurt by the decrease in tobacco sales? Yes, but I think they're also getting saved by the increase in the new nicotine products, w- vaping, heat not burn stuff, and nicotine pouches. I don't know. I think these companies will be around for a long time. If electric vehicles take over, though, I think that's a bit of a risk, and they're gonna have to bridge the gap to a new business model because a lot of these are gas stations, correct?
Yeah, they I listened to this interview one time with this guy he was a recurring customer of nicotine pouches, and he said I got an electric vehicle so that I would stop going to the gas station to because every time he'd go to the gas station to fill up, he'd get nicotine pouches. And then he said, now I just go just for the nicotine pouches. So I wonder if like the convenience store operations, which for most of these businesses is where they earn their margins, where they earn their profits. Um, I wonder if those would still do all right in an EV world.
Yeah, maybe. I think it is a point of uncertainty though.
That's fair.
Oh, it's gonna be multi-year.
Did you see Microsoft's reporting changes?
I saw that they made reporting changes, but I did not want to spend any brain power looking at it because it's just a company I'm not going to be investing in.
Yeah, it's very confusing. They don't really say how they rearrange stuff, but basically they're reclassifying how they report certain segments. And they had this little graphic that shows like here's what the growth used to be for every segment. After we reclassify, here's what the growth will look like. And every single segment, except for one, is growing by
So
more.
they put all the
It's
bad
growing
segments
faster.
and all the bad subsidiaries in one segment, and then all the good ones in yeah.
I guess so.
It's annoying. It's annoying. It's similar to Alphabet. I guess Alphabet is really one to underplay themselves and tries not. But it's frustrating, I guess, in the opposite direction where it's like, well, give us more detail. I know some of these are doing better than you think, but with Microsoft, they do play a little bit of the Disney game where they reclassify to try to hide some things, I think. But maybe I'm looking at it too cynically. We have a question here. Says, are there areas that you would never invest in? For example, would you invest in businesses in a commodity sector, or does it just depend on your circle of competence? It's more on circle of competence for me. I definitely would invest in a commodity sector, but for example, in the past, I've looked at the lithium producer. Hard to say its name, but it's Albemarle. ALB, I think, is a ticker, huge lithium producer. But when I looked at the industry, I saw that there's basically a ton of lithium in the ground, and all it takes is governments and companies deciding to dig it up. I don't think that's a great way to invest. And I had no sort of any sort of predictive power where lithium prices were going to be. So why would I buy? And you have
Yeah.
countries that are going at things like this uneconomically, like China with other sort of commodities. So why would I invest in this? I think Buffett says that, I guess it connects, like the two questions relate, because would you invest in commodities? No, because it is outside of my circle of competence, because it is commodities and not driven by things that I think are predictable.
Yeah, I never say never here for me. Like, I don't know if there's an area where I would just absolutely write it off right now, but I think the likelihood that I ever end up investing in anything that's highly commodity dependent, like an oil and gas, like a lithium miner, or anything like that, is very low.
Yeah, oil's a little better because the supplies are limited, but I think people predicting fracking in 2005 to take over the world, or take over the United States at least? No. And there could be technological developments that lead to, more supply unlock. We have a question here from Will that says, enjoyed the discussion on hims and hers last week. Any thoughts on the recent drawdown due to Eli Lilly entering the GLP-1 space? I do not have any thoughts. Here is my overview on hims and hers, and go listen to my discussion with Paul Serra last week, who did about 20-30 minutes on the company, and there's plenty of other reports out there. When you make a bet on hims and hers, a company like this, high risk, high reward, trying to disrupt a sector, trying to maybe enter gray areas from a regulatory perspective that Paul talked about last week, you make the bet and you let it ride. It's either going to work or it's not. Don't worry about news items hitting your timeline every day. Just like Eli Lilly's entering the GLP-1 space. Okay. That shouldn't really shouldn't change much, right? Just hold it in your portfolio. And if you're not comfortable holding it when Eli Lilly announces something, well, maybe you shouldn't own it.
And I would caution against buying on constant dips, because you never know when because this hims and hers, I wasn't a part of the Paul Serra discussion, so maybe there's stuff that I missed, but that's the kind of company that's going to have news on a very regular basis, and probably news that could actually impact the business, any sort of regulatory concerns, stuff like that. So if you're buying on every dip, you might just end up buying constantly until it's too big of a part of your portfolio and you're not comfortable with the business. So I recommend, like Brett said, buy it and just look away.
Yeah, exactly. All right. We have, I think Tyler says, is there a way to analogize? Sorry, Peter Lynch's teaching around retail, where you go from a 10% to a 90% market share, and looking at a reinvestment runway, but for a sector outside of retail and restaurants. Yeah, I think you just have to look at market share. And the internet has changed the game because a lot of companies can go global right away. I'm researching Remitly for this week's podcast. I know we had a question from a listener on Twitter saying, why don't I own Remitly? And I think the question will be answered on that podcast. I'm not going to buy until I finish my research on them. So it's kind of a, you know, there's no reason I don't own them yet. It's just because I haven't finished my thoughts. But something like that, you can look at, they brag about, say, 2% market share. It's really inched up over time. And you can say, okay, they're at 2% market share. The value proposition works. Everyone has the same phones. You either have iOS or Android around the world, at least in the markets they operate. And everyone has a similar value proposition, right? You got to get money sent and you want to trust the person that's doing it. So I think looking at market share can be helpful, and looking at whether they've been a market share taker. And if they have, like, okay, if someone's taken market share, it's usually fairly predictable that they can go from, if they've gone from 2% to 5%, that they could go from 5% to 15%. Now, when you're at, say, what you mentioned with 7-Eleven and that other company, if you're getting into that kind of 15 to 20% range, maybe you're hitting some sort of wall, because it's really hard. I know when we talk about either consumer goods companies, there's a lot of analysis out there about how things turn into oligopolies, where for example, you have like a Red Bull and Monster in the energy drink space, and they both kind of hold 40%, 30% market share. And then you have some other smaller players, like the third player that has 15%. And then you have a few other players. Someone that has low market share has taken some market share and probably has a lot of room to run, is where I would look at it for a lot of these internet companies.
Yeah. The market, I think sometimes people are looking for like the market share charts that have all the competitors and like are one succinct page to do it. If a company is growing quickly and the industry itself is not some massive growing space, they're pretty much a market share taker, and you can analyze that. And my biggest thing, I've really like forcing myself to do this more and more, is when you finish research on a company, go and try to do some research on their closest competitor, because it really does give perspective on, okay, who's stealing share, which company is worried about which. I try to do
What
this
are
with,
management teams talking about?
yeah.
Yeah.
And it's easiest when they don't have like a big private competitor. For example, Paycom, it was pretty easy to look. You can, most of their competitors are public, so you can go ahead and you can look at a lot of them, and you can really get a sense of whether or not they're a share taker. But whereas a company like SEMrush, their closest competitor is either a private company or Google Search Console, and you're not going to get a whole lot of information on Google Search Console. So sometimes it's easier than others, but yeah, I guess I don't know if I really even answered the question, but yeah, market share taking is probably the thing you really have to try to boil it down to. And I think we said this in the other episode, but I would rather have a market share taker in a slow growth industry than a fast growing company in a fast growing industry, because it's going to get competed away. The other thing I was
Or
just going to
they
add,
might, well, it's just going to be more competitive. There's going to be a lot more competitors in a
yeah,
hot industry.
yeah, the you mentioned the 15 to 20% thing. It really depends. For like the convenience store market, it's going to be hyper competitive, and it's a lot easier to start a convenience store than start a home improvement retailer. Like for Lowe's and Home Depot, their economies of scale are always going, they're probably going to continue being a positive feedback loop for them, where they continue to steal share, they can undercut the competitors on price, or they can invest the proceeds back into the business and improve the experience. So the biggest thing for me is just look at what are they doing with the profits they generate. If it feels like they're continuing to be the low cost provider, then I would say it's unlikely, if you have a scaled business that continues to be a low cost provider like a Costco, it's unlikely that they will stop taking market share.
Yeah, as long as the business is well run in the same way that it's always been. We have one more comment, and then we can move another one. Our own topic says, "Hello, gents. CrowdStrike earnings today will be good fun." I can see this is definitely a British or not an American listener. I still
Says
see
Mark
conviction
USA.
on. Maybe gents and good fun. That smells like British to me. It says, with CrowdStrike, I still see conviction on the long term if you can ride potential litigation. Still an underlying great business. Hey, look, if you have conviction that the product's great, that it's a great business, that there is a competitive advantage here, hey, keep holding it. But they had a big slip up. I think management might be going about it the wrong way by trying to blame Delta Airlines, because that's not going to just, like, publicly doing that might not end up well. You're supposed to be the one that's monitoring the software, right? Delta's outsourcing this to you and paying you probably hundreds of millions of dollars. Nah, maybe not hundreds, maybe tens of millions of dollars a year. So, yeah, the conference call will be fun to read. I think that'll be a fun one for anyone.
Yeah, the other thing that's worth keeping an eye on, it's if you're a sales rep at CrowdStrike, your pipeline, as soon as this happened, just broke. Like your pipeline of leads, every single person probably put their purchase or whatever their deal was on pause because they're worried about security concerns now. So you, if you're investing here, probably need to expect a billings or RPO, remaining performance obligations, slowdown, because it's a lot of those new deals are likely on hold for the time being.
Yeah, I want to see what they tell investors about the pipeline, how honest they are. If they get through this, though, it's a huge testament to their culture, the management team, and the business. Not to say you'd hope for any more of these outages to occur, but it's some sort of, I wouldn't, maybe not a moat test, maybe a bit of a moat test, but just a test for the business in general. All right, do you want to hit this Carl Icahn topic? Kind of a simple one, but seems like the man has, it's been maybe misleading, I guess, with his reputation. I don't know. You go into the details. Maybe we can discuss it.
Yeah, and I apologize in advance because I got a little bit of background noise here. But yeah, he was charged $2 million by the SEC. He failed to disclose, and a lot of this came out in a short report, failed to disclose that he was using his personal holdings in Icahn Enterprises as collateral for margin loans. He had pledged up to 65% of the outstanding stock as collateral. So this was a huge thing, and he didn't even tell shareholders. More or less, charged $2 million. Some of it was personal. Some of it was from the company. It's kind of a slap on the wrist.
$2 million.
But
okay, he's got some. He definitely is working the SEC. That's who. What information does he have on? What dirt does he have on all these people? That's what I want to know.
Yeah, I don't know how he kind of got skated by this one. Yeah, it seems like nothing. Before I do want to talk about our small cap of the week because this one's really enticing. But before we do, I want to mention our partners again. Public. Earlier in the show, you heard us talking about the investing platform, public.com. That's where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only. Have you ever heard of Nerdy?
Have not. What is it?
Let's talk through this. So, this is my small cap of the week. $124 million market cap, $87 million enterprise value. I think it was probably a recent IPO, I would guess, just based on the cash balance that they've got here. So about $40 to $50 million in cash in the balance sheet. They are, I'll just steal it from FinChat here. Nerdy operates a platform for live online learning. Its learning destination provides learning experience across various subjects in multiple formats, including one-on-one instruction, small group classes, large format group classes, and adaptive self-study. The company's flagship business, Varsity Tutors, operates platforms for live online tutoring and classes. It's been a high-growth business. In 2018, they had $72 million in revenue. Last 12 months, they've had $200 million in revenue, so it's growing quite quickly. Seems to be gaining steam in the education market. Now, I think the education market is a little fickle. I would really not be interested in this company at all, except for I saw something last week, which kind of blew my mind. The CEO, founder, Charles Cohn, last week, keep in mind, this is a $120 million market cap company. Last week, he bought $12 million worth of stock in the company. He doubled his stake by purchasing 11% of the outstanding shares in 1 week. So,
would you buy blindly off that? That's pretty interesting.
It's the Peter Lynch thing, right? Like,
yeah,
the chances that a company like this goes insolvent in the next year after the founder, who knows the business far and away the best, has the control over costs, like he can cut marketing spend if he wants to, that kind of thing, doubles his stake, buys 10% of the company. Yes, I would probably buy some starter shares just purely off of that. I don't know the business very well.
Not investment advice. That's a pure hypothetical.
Yes, just to be clear, I have not, and certainly not financial advice. They expect to return to durable and profitable growth by the end of 2024. And they did get to operating cash flow positive 2 quarters ago, had a down quarter this quarter. Be curious what's going on there, but they've got if they can get to basically like break even cash flow or even positive cash flow margins, it's still a growing business. It seems durable. Maybe there's a scenario they've got $40 million in cash. Maybe they could be buying back stock as well. I don't know. It's enticing.
Yeah, and I'm sharing the screen here from our friends at FinChat. Use our link in the show notes, get a 15% discount. EV to gross profit 0.6. Pretty cheap on a gross profit basis. Now, it seems like a classic Ian Cassell microcap where, and I have no idea whether he owns it or if he even has heard of this company, where he loves a company that goes from slightly negative margins to break even to, say, slightly positive profit margins, where they essentially tell the investment community or prove to the investment community that they can generate a profit. Because once they do that, that can lead to a huge, not only are the earnings growing, but you can get a big multiple expansion on top of that.
This is also a shameless plug for one of our sponsors, Yellow Brick. This is a good example. Don't know the company at all. Looked at Nerdy for the first time. Saw that the insiders were buying. I just went to join yellowbrick.com. Looked up the ticker NRDY, and here's a high quality. Well, I assume it's high quality because most of their pitches are. You can read the full article. It's a pitch from looks like a Substack. And you just instantly get high quality write-ups, like on pretty much most companies globally. It's been rare that I've looked up a ticker and not seen it on here. So it's really easy. It's an aggregator of the best stock pitches across the internet, and you get them all in one place. Plus, I've been using the newsletter a lot more. So if you go to joinyellowbrick.com/chitchat, you can get a discount on any paid plans. You can also check it out. It's free as well to just look up stock pitches. You'll get, I think it's a month delayed on the free plans. So there's still huge catalog of write-ups in there.
Beautiful. Yeah. With the freemium model, check it out. Anyone can go check it out. But the value is in the aggregation and the time it saves you. All right. We had a question on Nerdy on revenues. Since 2018, revenue has grown at a 20% annual rate. Looks like pretty consistent there. And then we also had a question on gross margin. Now let me pull it up quick from our friends at FinChat. Click over margins, gross profit margin trended upwards. December 2018, 63%. So I think that's full year 2018. Last 12 months, 69%. Peaked in 2023 at 70%. So it's only down slightly, but generally it's trended upwards. So 2 positive developments there too. Definitely interesting. So many of these small caps that you find, and it's great that Yellow Brick finds so many of these. It's the high risk, high reward, and the basket approach makes a ton of sense to me if that's the style that you want. Where if I'm seeing these sub-billion-dollar market cap companies, a lot of them are risky, but take a basket approach at 10 to 15 of them. Maybe you make it 20% of your portfolio, say about 1% position each. I mean, over time, some of these will turn into huge winners. Some of them will go to zero, but then it'll become a larger percentage of your portfolio if they end up being a 10-bagger.
Want to talk about what happened with Pinduoduo?
Yeah, let's do it. Our friends over in China. I guess this is more what we call Schadenfreude. We're very, say, anti-Chinese stocks just because of how the government treats a lot of the businesses and the fact that we don't know the market at all. It's a market that's really, really hard to analyze as a foreigner. I can look at a place like Europe or a place like Mexico, and I think I can get a better grasp of how things are without getting boots on the ground. But in China, it's a lot different. Really, here's what happened. PDD Holdings, owner of Temu and Pinduoduo. Pinduoduo is similar to Temu, but a little different. It really dominates the Chinese e-commerce market. They saw their stock collapse about 30% after saying growth and profits would disappear in the coming quarters. I can bring up the press release because it was interesting. Like, maybe, yeah, let me try to find it so I can read the full quote. They did essentially on August 26th, they announced their second quarter earnings. They go through a classic thing where they go second quarter highlights. Total revenue increased 86%. Operating profit increased 156%. Net income increased 144%. And you're like, okay, great. Another good quarter. Then you get to the quote here. I'm going to read this. And it's really shocking how negative it was. Quote, while encouraged by the solid progress we made in the past few quarters, we see many challenges ahead. We are committed to transitioning toward high quality development and fostering a sustainable ecosystem. We will invest heavily in the platform's trust and safety, support high quality merchants, and relentlessly improve the merchant ecosystem. We are prepared to accept short term sacrifices and potential decline in profitability. Another quote, in the past quarter, our revenue growth rate slowed quarter on quarter. Looking ahead, revenue growth will inevitably face pressure due to intensified competition and external challenges. Profitability will also likely to be impacted as we continue to invest resolutely. That is those are some scary quotes. Now, there could be lost in translation a bit, but I see those numbers. I see their figures, and I go, what's going on here? Someone rugged the shareholders, and I wonder who it is. It's either the Chinese regulators, it's either the management team, or yeah, I guess it would just be those two. But I wonder why. Why now? What's going on? And I think there could be a few things that occurred. One, their merchants are really mad, or their merchants have some scandals on their platform that they're not really, there could be like, okay, is there lead on this stuff or something like that? Second, they could be doing accounting fraud. No idea. They could be. Or third, the regulators are saying in China, you're too profitable. Kind of an Alibaba style. A couple of years ago, you're too profitable. You're too big. Hey, lower these profit margins. Why don't you? Before we make some changes over here and get a little bit more aggressive. It kind of a mafia style. It would be in your best interest to lower profit margins from to 10% or whatever the number would be. What did you think after seeing this or hearing some of those quotes?
Yeah, it's bizarre because they're already like the lowest cost provider by a mile, like globally. So I wonder if they came in and said we want even lower prices. It seems unlikely, but it's so, I don't know. This is why we avoid China. It's just super unpredictable. Like, you read those first few bullet points and you think, wow, that's a great quarter, fantastic. It's growing just as I expected. And then they say, we don't want any more of it. Like, profits are going to disappear. It's pretty concerning. And you know what? This is one of those where we have avoided Chinese stocks for a long time. And I'm really glad we have. I think we got some skepticism from it. Yeah, you look at that revenue chart. Oh my gosh.
No, that's not revenue, Ryan. That's cash and short-term investments.
Oh, wow.
$40 billion in cash. I
Is that
think that's
USD?
yeah, I have it on USD. Yep. And
Oh
they're
my
not buying back or
gosh.
paying a dividend.
What do they do
Why
with
is
it?
that? Yeah, well, my question is it there? Or are they allowed to give it back to shareholders?
Well, they're definitely not. It feels like Chinese companies rarely give it, especially Chinese tech companies rarely give back cash to shareholders. It's just frustrating. There are a lot of Chinese companies that seem promising, but it's hard to invest just because it's frankly unpredictable. The regulatory environment is concerning. They remember when there was the legislation that was going to be introduced that would delist Chinese ADRs?
Right. Yeah.
It
Let's get that
seems
back.
concerning that Chinese companies like this are, not like Timu's necessarily doing anything that's that harmful, but they're getting U.S. foreign investment. And if they're going to get penalized or whatever, if it somehow ends up back in the hands of like the Chinese government, it's really quite a good operation from the Chinese perspective, because they're not giving this money back and people are still willing to directly invest in it.
Hey, I got a PE here of 9, Ryan. Last 12 months. PE of 9.5. Are
What
you
if
buying? And
shares
look, with
outstanding
that,
look like?
yeah, with that cash balance, that EV to earnings is going to be quite lower. Let's do total shares outstanding. Let me just go as long as we can. Change to a bar chart. Well, it's just been going higher.
Yeah, and they listed a bunch. Looks like
I'm
2018.
guessing 2017 is the IPO. Market cap 133 billion USD, EV 95 billion. Hey, buy back stock. If they started buying back a ton of stock, would you have any more interest?
Yeah, but
Or do you want a
that's not
dividend?
going to happen. No, I'd prefer a dividend for sure.
Yeah, yeah, it's kind of like say a Mexican company or a lot of the companies that we've looked at in Latin America, where the dividend can help with any sort of foreign currency risks. Can hedge that a bit. Let's see, we have some comments here. They have zero reason to have American shareholders' interest at hand. I think if you look at their actions, I agree with that. Just as Chinese companies as a whole, sounds like Colin Zhang wanted to avoid going on a month-long vacation. Another comment there. I think that's the founder. Also, no actual ownership under Chinese VIEs. You own nothing. Don't worry. You can sue in the Caymans. Yeah, I think this is a Cayman Island company. So they also say in the press release, which I think is funny, the headquarters are Dublin and Shanghai. Now, that is a combination I do not want to invest in because Ireland is another place where people go to avoid regulations and sanctions. But yeah, I think that sums it up.
Yeah. No, China remains uninvestable for the time being for me. What would have to change for you to change that strategy?
From the top, what I mean from the government, I would need to see words and actions around actually embracing capitalism, not going after companies just because they're profitable, not going after executives just because they're rich. And then from a company perspective, I would want to look for a lot more clean structures from a governance and basically just the business structure. And then I would look for much more returning capital to shareholders, which, I mean, Japan didn't have all those problems, but it seems like Japan has fixed the governance or the government is working to try to fix the company's governance and capital returns programs. And that seems to be a much more attractive market. If you're looking at East Asian economies that have terrible demographics, Japan might be a bit better for American investors.
Yeah, I mean, their capital allocation is pretty conservative as well, but at least, there's some returning of capital to shareholders.
Yeah. All right. We had a question on Twitter. Someone wanted to talk Tesla full self-driving. I thought it was interesting listening to that Invest Like the Best interview where
I did not hear it.
so the ex-semiconductor analyst and tech analyst that now runs a fund called Atreides Asset Management, Gavin Baker, pretty big expert on semiconductors, I would say, from listening to that interview, and longtime shareholder, I think. Now, check the 13Fs. This is not any sort of confirmation. I think longtime shareholder in NVDA and Tesla, so done quite well. He said that the biggest benefit of AI might be in the near term will be Tesla full self-driving. Tyler says, do you think Gavin was being a bit hyperbolic? I think he was. I think he was doing it maybe for the podcast. It's not, we have a podcast, not afraid to put out some hot takes out there from an investing perspective. And someone asked about that. I would say I have no expertise on that. Ryan has none either. But what I do think is interesting is looking at, and people wanted to have an update on the EV space. I would look at the charts, and there was a great chart in the Wall Street Journal, and just look at the data out there. We've seen a reversal in the United States, at least, where electric vehicles this time last year were growing unit sales 50% year over year. Plug-in hybrids weren't growing at all. That has reversed. Plug-in hybrids are growing 50% year over year. Full electric vehicles are flatlining. They're not growing on a total unit sales basis. You can see that that's why Tesla's prices are declining. That's why Rivian's not growing its unit sales. And that's why some of these other companies like Toyota are thriving in 2024. And I think that is the most important thing to watch for these automotive companies at the moment.
Yeah, that's fair. I have very little to add. I haven't listened to the show. If you've owned Tesla and NVIDIA, I've listened to Gavin Baker a number of times. I like what he says. I would be uncomfortable owning those two stocks, but if you've owned them thus far, like, my gosh, congrats. Tesla less so lately, but yeah, he's had a good
Yeah, I
run.
guess Tesla since 2021 hasn't done well. One thing that, again, he knows way more. Going from that interview, he knows way more about semiconductors and AI than I do. But from my seat, people have been promising that Tesla full self-driving would be a game changer over the next 12 months for the last 5 years. So right now, I think those type of people are a boy who cried wolf situation. I honestly think the same with AI could happen over the next couple of years. We better see some real breakthroughs with this spending. He said what I think was interesting, and he did have some great points around the overall return on invested capital at some of these companies, Amazon, Microsoft, Meta, and Google, the ones that are spending a ton on data center infrastructure. So the ROIC has been improving. One pushback I would have on that is that they've just extended server lives. So I don't know if the ROIC was just understated before, but saying that anyone that's a skeptic on AI return on investment is like laughably wrong. I would say let's maybe hold out and see what the jury says in a couple of years, because right now, how much is getting spent? A lot. A lot.
Want me to
Let's
look?
just see. I'd say let's wait and see.
Yeah, the CapEx charts are wild across big tech. Yeah, tons being spent on it. Yeah, I agree. We are seeing Andy Jassy had those tweets coming out about like the time savings for developers that they've been able to create. So maybe, maybe there is benefits that we're not recognizing, but yeah, it doesn't feel tangible yet, the benefits to me.
Yeah, like the
But I'm
time
also not in the
savings to
dev
me.
space. Like that's probably where the
Yeah.
majority of development is going, or the most clearest benefits.
Yeah, and I would say that is pretty clear. Like you can't really deny that. But if this is a labor thing, and all these companies, Amazon, Google, Meta, which are basically take rates on US and somewhere global consumer spending, while if a bunch of people are getting laid off, like eventually it's kind of circular, right? We can't all just be automated. People have to get paid,
Yeah,
you know.
100%. Did you read the Target report?
I glanced at the headline numbers.
Yeah, pretty.
Probably just glanced at it at a FinChat. That's one of the best uses of the platform. I know we talk about our advertiser a lot, but it is nice to kind of get those headline numbers and visualize them quickly. Good report though, right, on comp sales?
Yeah. Yeah. Better. I mean, they're lapping a difficult period, so it would be concerning if it was negative again. But they're seeing better traffic. They said they were working hard to drive down prices in the stores. I will say it seems like the only two companies to report really solid, any two retail companies to report really solid consumer habits or consumer trends were Walmart and Target. And all of
That's
them
a
said,
Rorschach test.
yeah, all of them said, and there's probably some other ones that I'm missing, but they all basically said the consumer is spending less per trip, but we're getting more and more consumers in the door because we have the lowest prices and they're being more discerning about what they buy. So
That
where do
doesn't
we
sound that great.
stand with the consumer? I think
Yeah, we
we're
talked
kind
about
of in a
this.
spot now where consumer spending has tightened and the discretionary spending seems to be pinched.
Yeah, we talked about this with Paul last week. The macro stuff is very hard to predict. Like, if you're one of the perma bulls, you look at this and say Costco, Target, Walmart, Amazon, they're doing fine. People are spending money. But if you have the bearish tilt, you would say, well, people are trading down. That does not necessarily indicate consumer health. It indicates tightening of the budgets. And if that gets worse, that's pretty clear indicator of a recession. I I like the idea that Walmart, like, having a great few quarters is actually a bad indicator for the economy over the next year because it shows that people are trading down. But am I going to invest because of that? Am I going to make any investment decisions because of that? No. I think it's helpful to understand that maybe that's why Walmart and Target are doing well at the moment.
Yeah, it's nice to own companies that benefit from a difficult economy. And when you're a discount
Dollar
retailer,
General.
you're a dollar store, you're going to be in a good spot as long as you maintain that proposition. I think McDonald's has kind of strayed away from it a bit, and maybe that's why they're seeing like declining traffic, but it is nice to be sort of counter cyclical in that way. Walmart, can you guess how many quarters in a row they've had positive comp sales? Their current streak.
So I'm guessing pandemic. Can I say pandemic? They were all positive?
They were.
100.
No, 40. But
Pretty
40,
good.
10 years in a row, every single quarter, positive comp sales. It's pretty impressive, even lapping the pandemic. So,
Oh, yeah.
and lapping the, what you would call it, stimmies. Haven't said stimmy in a while. Remember those? Stimulus checks?
Yeah. Those were interesting as well. And definitely those last ones may have been the worst thing for inflation, I gotta say.
Yeah. Remember Target and Walmart? Everyone got stimulus checks, and a quarter later, they're like, our TV sales are off, though. We've never seen this
Yeah,
good.
exactly.
It's like, wow, look where it's being spent.
Yeah.
Yeah, they
Okay,
all
well, we had
reported crazy comps in their electronics segment.
yeah, I thought that was funny, yeah. Okay, we had a commenter ask about target gross margins. I mean, well, last year, I think they took a big flush on some inventory, but pre-pandemic, they were at about 29 to 30%. Looks like they really have a target to hit, no pun intended, 30% on the gross margin. Last 12 months, 28%. Let's look at trailing maybe.
It's lower ticket items seem to be the ones selling, so maybe that's hurting them.
Hey, look, even with those positive comp sales, and they talked about trading down and discounts and stuff like that, gross margin has improved from the trough in January 23 for 1, 2, 3, 4, 5, 6 straight quarters. So positive good comp sales, and they're not selling $1 for 90 cents.
I see a comment here that says, did you guys see Kathy Wood sold Zoom? No, I'll be honest. I don't really track her holdings much anymore. There was a period where it was kind of fun.
Did you ever?
Well, I think throughout COVID and stuff, it was kind of fun for talking points. Like,
That's
especially
true.
once
Yeah.
everyone, and I probably did this too, were taking victory laps because, the main reason was that she had very, very, let's call it aggressive assumptions. I thought they were a little dishonest or disingenuous, and it was just a way to kind of promote her fund.
Well,
if
you sell Zoom 98% below your price target.
Yeah. So it was nice for a while there, people were taking victory laps and saying, oh, look, this fund's down however much. At this point, I'm kind of bored of it, and I don't really track it quite as much. I'm curious what the AUM is in the ARK Invest ETFs.
Ooh.
I wonder
Look
how
it
high
up.
it is.
Look
I'm
it up on
guessing
FinChat.
most people have lost money on
I
ARK
got two
Invest.
trivia Yeah, you look that up. I got 2 trivia questions for you. Returns for Zoom stock since its IPO in April of 2019, positive or negative? What do you think? Can you guess?
Sorry, repeat that. I was looking this up.
Okay. Zoom went public in April of 2019. Cumulative return since then, positive or negative?
Well, I think because you're asking, I'm going to say negative.
Positive, but
Okay.
only positive 13%.
It's 4% IRR.
That's I think that's like a 2% IRR. And can you guess their market cap?
Yeah, sorry, that's a 2%. Dang, it's already 2024. Market cap, let's go 9 billion.
22.
Really?
22 billion. Well, remember when they used to be bigger than ExxonMobil?
Do you remember when Michael Burry said, literally at the peak of COVID, he was like, how are we not at peak Zoom? And everyone's like, no, they're going to raise prices and like people stick around. And it was perfect. Like it was perfect timing. One, competition came. Two, people didn't need it anymore. Like everyone at the time was working remote. You switch to a hybrid environment. You don't need Zoom as much. At least don't need as many seats. You don't need, I mean, it's just like all the reasons supported it and people called him crazy for it. And it was so prescient. I mean, he could not have been more right on his timing.
Yeah, I agree. The man seems crazy, but fairly good investor. He has been embracing the Chinese stocks, so he is deep value, and he's not afraid to plunge into the depths. We have a comment here that says update on GoGo news. I'm not sure there was really anything that relevant. I mean, it's really just developments that people are expecting. I'm sure we'll do an update on them sometime next year as a part of a podcast. But right now, nothing's changed with my thesis. And I would go back to that full podcast we did on them, but we discuss why I own them. There's similar to hims and hers. This is one where there's going to be a lot of narrative out there, especially because it's competing with an Elon type company, Starlink, huge narrative around that. It's one where I made my investment. I'm going to hold it for many years. If it works, it works. If it doesn't, it doesn't. And that's going to be that.
Can you guess? Sorry, I just found this, so I know we're switching topics here. Can you guess how much ARK Innovation ETF has in net assets?
That's the flagship.
Yes.
2.5 billion.
6.
Wow.
$6
That's still
billion.
that's still pretty good.
I mean, that's a big fund. Yeah. That's a big fund. Performance has likely been inadequate. I'm not 100% sure, but I can actually look it up on FinChat here. ARK K is the ticker.
Have they beat QQQ since inception? I've been told that that's who Buffett needs to be benchmarking against. So
$10,000 invested in ARK's Innovation ETF 5 years ago, you would have $11,000 today, roughly 10.9. So positive 9% returns over 5
compound that
years.
out. We're playing the long game. We're playing the long
3
game.
years.
Also, hey, go ahead.
The 3-year return is negative 63%.
Yeah, that's don't invest in the hot sectors at the top. Lesson everyone needs to learn. All right, we're going long, but did you see Buffett or Berkshire hit $1 trillion market cap?
Really?
Yeah, get that FinChat tweet out. Yeah, that can be your FinChat tweet of the day. I already had a Motley Fool headline primed for this. He's really doing it for trying to hit our bonuses for clickbait headlines.
Wow, good for Warren. I wonder if he's having an extra Coca-Cola today.
Yeah, maybe. I have no clue. He's also outperforming, I think, on 3, 10, and 30 years versus the S&P 500. So,
Do you think?
Not bad.
What do you think is a bigger milestone for him? Taking the company to $1 trillion or taking the Berkshire A shares to $1 million?
Probably the A shares to $1 million because per share matters to him more, especially because he understands that that's what's more important versus the market cap. I think those are the two milestones he wanted though before he passes away.
It's an incredible accomplishment. Good for him.
Yeah. Run those numbers.
What
Get
was
those
the
viral
text to
tweets
help?
out.
What was the textile mill worth when he bought it?
I think less than 10 million. I think like $7.5 million, something like that.
It's some decent compounding right there.
Yeah. All right.
But you know
We're going
what?
a little long, but thank you all for the people that joined live, ask us questions. Ryan, anything else before we close out?
I was just gonna say, remember how we were like skeptics about all the fund managers that just have Berkshire as their biggest position because it seemed a little redundant? Good for them.
Hey, yeah, that's true, but it has outperformed. And if you buy it right, if you buy when that price to book's low, man, it's a manager and that's a management team you can trust. Okay, but yeah, let's close things out here. Thank you everyone for tuning in live. We do these Wednesday around midday Eastern time. Try to do it at 1:30 p.m. Eastern time, but sometimes with our schedules, we have to mix things up. I haven't said this in a while, but if you've listened to this full episode, give us a review on Spotify or Apple Podcasts. It's the best way to grow the podcast. Let's hit the disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, once again, and we'll see you next week.